let's kick things off here. Welcome everybody again. This is another episode of Money Moves. This is our Twitter Spaces series where we talk about all things tokenization, all different sides of it, how it's being developed, how innovation is happening on Avalanche. And we're excited to dive in today with our partners from Re and from Nexus Mutual. So we're going to give them an opportunity here to do a little intro on themselves, and we'll kick off the conversation from there. So let's start with you, Karn. Why don't you tell us a little bit about you and your role with Re, and then we'll go over to you after that.
Yeah, sounds good. Hey everyone, I'm the CEO of Re. We are an on-chain reinsurer. For those of you who aren't familiar with what reinsurance is, it's like insurance for insurance companies. So our customers are exclusively admitted insurance companies around the world, starting in the United States. We wholesale take risk off of their balance sheets to enable them to grow their businesses, enter new lines of business, explore frontier lines of business. Right now we back 9 U.S. insurance companies, put on a considerable amount of premium, have a significant amount of pipeline. And you'll hear me talk about this over the course of this conversation today, but insurance and reinsurance, and I'm sure Hugh will agree, is the perfect use case as kind of a transition of moving risk transfer on chain, largely because we sell an intangible product that's memorialized as a contract. And there is, in my opinion, no better way to do it than in a completely transparent, immutable way that coordinates all counterparties and obligors. So I'll leave it at that. Maybe Hugh, you want to introduce yourself?
Yeah, thanks, Karn. Hey everyone. Name's Hugh Karp. I'm the founder of Nexus Mutual, and we do similar stuff to Karn, but maybe in a slightly different way. I'm sure we'll get into that in a bit more detail. But we're an on-chain marketplace for risk, and so we primarily cover smart contract related risks within DeFi and on-chain, as well as a bunch of other things. But we're kind of like, we fully run everything on-chain. And yeah, looking forward to kind of getting into more detail about how Re and Nexus work together, and how we're kind of doing similar stuff, but in perhaps a slightly different way in places. So that's kind of the quick background.
Awesome. Yeah, it's going to be exciting to see how these two protocols work together, and I think there's a lot of stuff to showcase that's brand new to a lot of people. So let's dive into it. Morgan, you want to say hello and take it away from there?
Sure. Thanks, Kyle. And thank you, Karn and Hugh, for joining us on this latest episode. Really excited to dive in, maybe just for the benefit of our listeners and just to kind of level set on the Money Move series. We started these spaces, I guess sometime last year, as we were working with more and more partners on Avalanche, specifically on tokenization in some way, shape, or form. And we really wanted to use these sessions to kind of create a space to ask, like, I don't want to say stupid questions, but like make things more accessible, and use this as an opportunity to explain concepts that who are doing this like every day, all day. We start to take these things for granted. Like, we're in a rabbit hole of rabbit holes, right? And we talk about wholesale banking and capital markets and balance sheets and all these things, but we want to be able to kind of, to the extent possible, really make these terms and concepts as accessible as possible for our community, for potential investors, for potential partners, and kind of go from there. So we may or may not have time for questions at the end, but I try to, ask these questions in the way that, really tries to bring things down to as accessible of a level as possible for not just myself, but also for our audience and for our community overall. So with that, would love to dive in. Karn, with you first. I mean, I know you mentioned at a high level kind of what you guys were focused on, but let's maybe take like a giant step back and talk about maybe if you want to even just talk about like the reinsurance space today, like what it looks like, who are the different players, why it's such a complicated, definitely not transparent, opaque industry, not standardized, and like what are all of the problems that potentially exist in the industry as it exists today, which I'm presuming is the thing that caused you to create Re in the first place. But maybe let's like level set and talk about that. And then obviously, Hugh, if you want to kind of opine, I know you mentioned you guys are focused on building and ensuring that most, if not all of your components are on chain today as well. Maybe let's start there to level set, and then we'll go from there. So Karn, let's start with you.
Yeah, for sure. So I try to spend my time working on things that I think are going to be inevitable. And one of those things is all of insurance and all of reinsurance moving on chain. Meaning that, you know, I've had the benefit or the misfortune of scaling a national insurance company in the past, cover.com. And so I've you know, was able to develop a pretty good feel for all of the intermediaries in the space, a very good understanding of how data and cash flows, you know, from the origination or the sale of an insurance policy, all the way to capital markets. And so, you know, insurance, reinsurance are chock full of intermediaries. You know, you have folks who sell the policies, you have brokers, you have reinsurance brokers, you have primary insurance companies, you have insurance companies that act, purely as fronts that don't take balance sheet risk. You have reinsurers clearly that take risk off of insurance companies. You have retro markets that is effectively insurance for insurance for insurance. What I, you know, view as inevitable is the chain, and the information and the capital, will at some point or another be transparent from the inception of a policy all the way to the risk bearer. In you know, in my viewpoint, and I think Hugh will agree with this, is effectively there'll just be a remutualization of the entire insurance industry where the folks who are providing capital are the policyholders and also are effectively the insurance company. If there's a single problem, with insurance now, it's the fidelity of information from when an insurance policy is sold all the way to the end of that chain. And so if you were to talk to 100 underwriters or actuaries, you would see that, hey, when an insurance policy is sold, you have near complete information. As it changes hands between, you know, the numerous intermediaries in this insurance value chain, it gets sanitized over and over and over again. It gets aggregated over and over and over again to the point where, you know, the folks who are actually at risk, the folks who are providing the capital backing to back these insurance policies, probably aren't in a good position to make great underwriting or pricing decisions. And so fidelity of data is certainly one aspect of this. The rest of it is largely a coordination issue, right? Like an insurance program, an insurance, you know, set of policies these are intangible. These are not physical goods. They're literally contracts that spell out explicitly, you know, what is covered, what are the obligations, under certain circumstances, what is the capital that is backing those obligations. And I don't see why at some point or another that those things couldn't all just be smart contracts. They couldn't be transparently conveyed in a way that benefits the insured. It benefits the regulator who's overseeing it. It benefits any counterparties, the insurers and the brokers. We're kind of at a state now in insurance where even the folks that are in the business, you know, think of this as the future, but think of it as like 25 years down the road. And I look at things like this and I say, hey, well, you know, banking thought of itself as 10 years late to fintech. Insurance thinks of itself as 20 years, reinsurance maybe 30 years. Things are going to move a lot faster than we expect. We're kind of in an inflection point where everything is going vertical, and being able to adopt, you know, stuff that's happening now in a massive opaque industry, that improves outcomes for policyholders and for people who are taking risks is just going to happen. That's what drove us into this particular space.
And let me ask you guys, actually, both Karn and Hugh, as it relates to, you mentioned, Karn, like the fidelity of data, as well as, enabling smart contracts to take the place of a lot of calculations that frankly probably a lot of third parties do and redo, and all obviously in silos. But do you guys have a sense of like, and I don't want to put you on the spot, but like any stats or any sense of like quantifying the problem of what happens when some of these things go wrong, or the amount of people or hours or time or money that it takes to reconcile these things? Like, can you just give us like a sense quantitatively, roughly, of like what these problems cumulatively look like?
I can give you an idea. I used to be the CFO for Reinsurance life operations in the UK. We had a relatively our team ran a pretty big balance sheet and all the rest of it. We were pretty efficient. We had about 100 people in the wider company, but the finance division was about 30, about a third of that. And honestly, I think about 25 of those people that I was looking after, you could boil down what they did day to day as reconciling data from different providers. Working out what the differences were and what the problems were and all the rest of it. And so I actually kind of think that like most of my job was effectively doing that, which was I don't know, pretty. When I look back on it now, it's a pretty sad state of affairs. But yeah, it's just all about making sure that you understand the data and that you've got the right information with which to make sure you're holding the right capital, make sure the profit's coming out correctly, etc. So, I think it's a very big problem within the industry, and everyone really does the same thing because there's no standardized data transfer type information, etc. So, I think like tokenization and blockchain, the tech is just, I think it's just ripe for disruption, and I think it's a really good solution.
Yeah, so even like you hit the nail on the head. Even if we're talking about a couple points of administrative overhead being abstracted away, because you can now get this reporting, this compliance related work for free by being on chain. That's a significant part of the economics, of an insurer or reinsurer. Moving by a couple points is a massive advantage over, books of business that could be tens of billions of dollars in premium. And so that could either flow back, you internalize that as profit, that could flow back to the policyholders in the form of lower rates, really depending on what, what it is that the entity that is a beneficiary of these savings wants to do. I'd also point out, like, it's very easy to lose track of, certain risks and one I'll call out is like, hey, we're committed to memorializing our capital, position on chain. And that, benefits the insurance companies that we back and makes the regulator happy because their job is to make sure that, we meet our solvency requirement. But it is, even in today, you still have massive, instances of fraud where collateral is misrepresented in the insurance market, right? You have insurance companies and reinsurers that will misstate how they utilize their collateral to go off and buy soccer teams or other illiquid assets.
Is that right?
They'll do things that they didn't necessarily communicate to regulators, and it takes some time to kind of unravel that. We've also seen instances of, multi-billion-dollar collateral fraud with Vestu, actually quite trivially, modifying PDFs that were, letters of credit to prove that they had assets. And then it seemingly, socially engineered, verification of those transactions by hiring on people to pick up phones, and pretend to work at a bank or a Chinese bank. So there's lots of crazy stuff that kind of can come out of this, but is impossible, if you're dedicated to the transparency and memorializing transactions and collateral on chain. And I think again, this inevitability, theme, it is almost certain that all of this business over the course of the next, decade or two is going to be moving to on-chain rails.
Right. And I really like how you mentioned, the idea of really starting the process like as upstream as possible from the origination. And therefore, I think from there, all of these other things that you kind of mentioned as it relates to like the administration and then reinsurance and all these things can kind of therefore flow from that. But I think, frankly, whether you're talking about insurance, reinsurance, or any other financial asset, the more upstream that we can go, frankly, the less service providers ultimately I think you'll need, and the greater the fidelity of the data and all the other products and services that are built on top of it. So I really like that point that you made. Real quick, before we go into the protocol, just give us a sense of why you decided to focus on reinsurance in particular. And then actually, if you could talk about, the protocol itself, and what it consists of, what are the products and features today / that will be imminently out. Let's kind of get into that.
Yeah. So why reinsurance? I mean, I built cover.com, which was a national MGA business in the United States. And so I sold policies directly to the end user. I sold auto insurance, home insurance, et cetera. I built, agency facing software. So thousands of local agents could distribute our products. Myself and my team who are on this call, we built apps, we built, direct consumer portal, we built custom CRMs. We found that we just couldn't make the business work, with the number of intermediaries that had a hand in the pot of the economics that we were generating. And so, we were paying fronting carriers, we were paying reinsurance brokers, we were paying reinsurers a significant amount, of our economics. And, the margin profile of the business ended up being, not as attractive as we had initially set out for it to be. And so somewhat selfishly, we took a step back and we thought about, hey, where is there an opportunity to build something new? Quite frankly, like where are people making money and not doing very much work is kind of the question that we asked ourselves.
It's a good way to think about it.
And so we visited, some of our reinsurance counterparties and, a couple dozen people, in a small office in, Macon, Georgia, handling multi-billion dollar books of reinsurance business. And effectively, when you dig into it, not much happening outside of them kind of taking a market approach to attaching risk, which means they're being as diversified and broad as possible, and signing relatively standard contracts, that could be replicated, whose individual components could be replicated as kind of part of a smart contract. And so if you think about, what the product is, it's quite literally a promise to pay coupled with proof that you can pay under certain circumstances, with the counter being insurance companies and their counterparties being the policyholders. And so what maybe took a little bit of time to percolate, because we thought about it for some time, was, hey, these things, these risks that we want to be party to, the counterparties, whether they're brokers or they're cedents, or whether they're third party adjudicators of claims, all of these counterparties could be memorialized in a smart contract. The risks could be very easily stamped out. And then what's important is that the regulator, the insurance company, and therefore the policyholder, have comfort that if things go awry, the capital is there to be able to fulfill the obligation that's within the smart contract. And so we pushed down this vein, and started off by effectively building out software that ingested information from insurance company partners, standardized it, and made it ingestible by distributed teams of underwriters and actuaries. And so the way that we operate today is, while we do have direct business and insurance companies come to us, we work with teams of underwriters and actuaries with a specialist focus that originate, price, underwrite, and submit business to us to be approved. And so, what we wanted to do is make sure that whatever we did next was also very, very high operating leverage. And so, partly building tools for these individuals to be able to address, price, underwrite, and submit this risk was a big part of what we wanted to do. And the final part, kind of analogous to what happens at Lloyd's, is we built a third-party capital transformer, so that, alternative capital and crypto assets could flow into each of these deals and back the insurance companies that, we thought and the underwriters presented as being potentially profitable opportunities. And so, worked on the origination, worked on the plumbing to make sure that we could memorialize all of these deals, made it possible for smart people around the world to pontificate on, or to at least address and price and do the work of assessing this risk. And then, importantly, Nexus and ourselves have now set a precedent around being able to transform, KYC on-chain capital into something that is useful as insurance collateral in the real world. And so a bit of a journey. I didn't come from reinsurance originally. I also didn't come from insurance when we first started off, but have attempted to scale very aggressively in this space and have learned quite a bit over the course of the last year and a half.
I'd say given what you did in your previous role, it definitely set you up and gave you a degree of expertise in this space.
Everything's fertilizer. And you're right. Like I'd be remiss if I didn't say I didn't know a lot about insurance and probably know more than most humans on Earth about insurance.
On Earth. Well, actually, to that end, and this is a question both for you, Karn, and Hugh, you and Karn, you mentioned like on multiple occasions, we strive to be the decentralized Lloyd's of London. And obviously in the context of the way that the insurance and reinsurance industries work today, there's obviously a lot of, ultimately unnecessary third-party service providers. When you guys both kind of set out to build both Nexus Mutual as well as Re, how do you think about the incumbents today, and talk a little bit about, potentially those types that you're looking to potentially work with, versus disrupt and kind of, what does that look like, and how do you see, I guess, the industry is evolving as they increasingly adopt this tech, from an insurance and reinsurance perspective?
Yeah, I'll give it a go. I think Nexus probably started in a bit of I think we saw the same problems, basically like connecting capital to risk in the most efficient way possible rather than going through a massive value chain with everyone kind of taking their slice along the way. And I think kind of that transparency and all the rest of it. So I think we've kind of started from the same problem, but we're probably tackling it from a slightly different spot. So like Karn and Re are definitely fully regulated, and they're kind of tokenizing the fund and the capital provision part. But facing the regular end customer is it's all kind of regulated, and that's a bit more traditional looking. Nexus started like fully kind of decentralized spectrum. So we bootstrapped our own capital pool from zero. We're fully running on chain. You can buy the coverage on chain. We also have started from risks that the incumbents don't cover at all, or they didn't cover to start with. We were the first ones to cover like smart contract risks and DeFi related risks. And so we started from a different spot. And I think two things there. One, insurance companies and markets tend to have always developed over hundreds of years by people or the communities actually coming around and starting something because they see a risk that no one else will cover. And I think that's kind of how Nexus has started with the smart contract risk and things like that. So, started there, but looking to expand into other risks. In terms of how that works with incumbents, from my perspective, I definitely think everything will move on chain, but I also think it's going to take a while. And so that means we from Nexus' perspective, we're really looking to grow in niches that are underserved, and where there's capacity problems or something like that. Because for example, competing head on against a very well established insurer or reinsurer in a highly competitive business line or something is not going to be what Nexus is going to be good at. It's going to be about something else, more of a niche product where it can't be served by the regular traditional markets. And I think there's always this bit of a tension in the insurance industry about like competition or collaboration, because like at the end of the day, a lot of people, like, you can't actually cover all the risk in one entity anyway. So, you do need to collaborate a lot more than you probably would in other industries. And so a lot of these problems have to be solved together. Naturally, if you've got everyone working on the same data and things are tokenized and all the rest of it, it makes it much easier to collaborate. So that's kind of, hopefully we can get there and things make it a bit better. But I think I wouldn't necessarily say we're coming at it from a naturally competitive point of view. We're more trying to push the space forward and cover people where they can't get coverage now, but also then use the tech that we've got and expand that into other business lines and stuff as well. And I think that this particular deal that we've done together is kind of a big first step in that direction.
We will definitely get into that very shortly. Karn, I want to hear your perspective, and then we'll get into the fund as well.
Yeah, for sure. And I'm aligned with basically everything Hugh's covered here. We started in the real world assets part of the spectrum here, backing traditional insurance risks with a specific foothold, backing regional insurance carriers, specialty insurance carriers, where there's a little less competition. And quite frankly, we also just lucked out launching when we did. We formed a regulated reinsurer into a hard reinsurance market, where rates have been going up, which helps our growth. Surplus capital for some of our competitors because of their investment policies, and certainly some of the insurance companies has shrunk given like long dated fixed income unrealized losses. And at the same time, the interest rate environment has improved our profitability as well, right? The basic premise behind our economics is we invest float that we generate from insurance policies, and if the risk-free rate is higher, we make more money. And if it's a hard reinsurance market, there isn't as much capacity. The expected margin taking risk off of insurance companies is higher as well. And so just turned out to be luck. I don't know that we forecasted it this way. But it also did make us a much more palatable partner, as an upstart reinsurance market, especially an on-chain one, to traditional market participants. I just want to reiterate, this is a massive market, right? Like it's incredibly large. To Hugh's point, a lot of deals are done alongside other market participants. And so, as kind of a rule of thumb, internally, when we back an insurance company, we're never the only reinsurer that typically backs an insurance company. We're part of a panel of usually 2 or 3 other reinsurers. And so when we set out to build what we are building today, it was with the view of like, hey, we can build new plumbing that improves data and capital transfer. It improves transparency. And that is a nugget of value that we can compound on top of. It wasn't necessarily to displace, reinsurance brokers or insurance companies, offhand. I think that what some of these intermediaries will have to do over the course of the next decade or 2 decades is show that they add value to the extent that they're able to capture value as part of an insurance or reinsurance transaction. But I'm fairly certain that, they would be hard pressed to go away unless you are completely vertically integrated, and that kind of takes some time. The machinery that backs all of these transactions is going to get more efficient. That's almost a certainty. But the coordination of, capital providers, the capture of information, the submission of those information is still going to require folks. And so we're actually built to be able to support the market as it is. We meet insurance companies exactly where they want to be met. And so we don't ask them to do things like modify the way that they submit data to us. We build software that normalizes that data. We build software that keeps track of capital flows, in and out of ourselves, in eventually, capital flows to the original capital provider. That's the type of plumbing that I think, is going to work in the near term. Will the market arc towards greater and greater efficiency over the course of the next decade or two? Absolutely. I think Hugh and I are well positioned to be able to take over a significant amount of the insurance business, given how many folks are simply just retiring out of this business. And so I'm optimistic that it gets to where, you have a much, much more efficient marketplace. But, that does not prevent some of these intermediaries from showcasing that they can add value, and, they'll have the opportunity to do so. Working with folks like us and doing things on chain.
Thanks, guys. And I think one point that you mentioned, Karn, that is particularly pertinent for bringing what I would say off-chain users or off-chain companies on-chain is, to your point, building plumbing that inherently connects with their systems that they already use, such that they're able to access and or reap the benefits of this platform without frankly knowing or care. I'm sure they know, but caring that it's on blockchain, but that, now they have these kind of great additional features or efficiencies or opportunities that they didn't have before. So I really like that thinking. I want to emphasize that, because that's when we talk about adoption, we always talk about, obfuscating those parts that frankly make it frictionful to access opportunities and protocols on chain. So thank you for that. I want to shift gears a little bit and talk now about the fund itself. And obviously Nexus Mutual was a kind of major key contributor in the first instance to the fund, in addition to the Avalanche Vista allocation as well. But Karn, maybe if you want to kick it off and talk about, what is the fund, and maybe let me pause and say none of this is financial advice. Please do your own research. If you're interested, we can connect you with Karn and or Securitize, and we can go forward from there. But Karn, talk to us about what is this fund that was launched, and then maybe Hugh, if you want to kind of add what made it attractive for you guys in assessing that, and then we can go from there.
Yeah, for sure. So look, we spent a fair amount of time, energy and money sorting out a compliant way to create a bridge into the crypto asset ecosystem. And the way that we settled was, hey, we're gonna use existing regulatory Lego blocks in a unique way that would enable KYC'd institutions and individuals that want access to the insurance and reinsurance market to be able to do it. And so there are, there's Lloyd's of London. There are names at Lloyd's of London. There are transformer structures that take in third-party capital. There's the entire ILS market that enables, qualified buyers or qualified purchasers to participate in very tranched out specific risks. We wanted to create something that was a little bit more elegant, simply enabled somebody to provide or an institution to provide capital into this particular facility, which is an open-ended fund that's redeemable. And then, use again existing and approved regulatory, financial instruments, to turn the assets that we captured through the fund into compliant admitted insurance collateral. And so effectively what that means is, hey, you can now put down some money and you are earning a return against a basket of insurance companies. Ostensibly, it could be hundreds of insurance companies starting in the United States and eventually around the world. And the specific problem we're solving is just there's lack of access to this massive market. And quite frankly, there isn't the fidelity of data for individuals, even accredited investors, historically to get comfortable with these types of risks. And what we've endeavored to do is, one, that we've built the infrastructure to make sure that the data is there for any person or informed entity to be able to dig in. And then two, use these existing regulatory Lego blocks that we could snap together to create something new and novel that flows, potentially any KYC to on-chain capital into the real world, and again backing hundreds of insurance companies. That was kind of the North Star for us. From the best of my understanding, we're the first to be able to have accomplished this. And so it has been, a precedent-setting thing to do, and quite frankly, a precedent-setting transaction. So proud to have kind of achieved it and worked alongside Nexus and Avalanche to do so. But that is effectively what the fund is and what its purpose is.
And thanks, Karn. And Hugh, would love to kind of get a sense from your perspective. Do you guys have obviously, I guess you guys have a mandate, or how did you look at the investment in the underlying fund? What are some of the things that you guys took into consideration? And then potentially, how does that, I guess, fit into your broader strategy as it relates to Nexus Mutual?
Yeah, I think the first thing is, like, we looked at this at very high level. Like what Nexus is trying to do, and also what Re is trying to do is connect on-chain capital with risk. And we knew that we could do some stuff, and we also knew that Re could do a bunch of stuff that we couldn't do. Like, so that they're interfacing with the regulated world, the insurance licenses, all the regulators and all that stuff. And we're operating very much in the decentralized world, but we're also sitting on a bunch of capital that we want to allocate, and back risks. And so I guess from a very high level point of view, we saw a strategic benefit for both companies to work together. Like, in and of itself, this particular deal, I think it's good, and the terms are great, and it, went through all of our mandates and all the rest of it. Our members voted on it and approved it. But I think the real benefit for all of this is it's the first kind of major deal of bringing on-chain capital to back real world risk. And I think it's the first building block for which we can hopefully do more and more. And we had to kind of make some simplifications and stuff along the way to make sure that the regulators approved it and all the rest of it. But I think hopefully both of us see it as definitely a first step with which we can build further on. And you have to open the door and get the regulators comfortable with step one, and then you can take the next step after that. And hopefully this is definitely just the first step, and there's more to come.
And I guess, Hugh, from that perspective, you mentioned, this is definitely a really great example of applying or bringing on-chain capital to off-chain or real world, however you want to call it, opportunities. As you are kind of speaking from the perspective, I would say, like a on-chain institution, crypto native, however you want to phrase it, for those out there that are kind of mulling these various opportunities, what are some of the things, especially since you guys obviously went through KYC, went through the onboarding, like what are some of the things that you feel like those who are considering this should think about, whether from like a return perspective or a duration perspective or a risk perspective? Like what are some of those kind of parameters? And then Karn, I do want to ask you also, like, is this type of thing something that you guys have found would be compelling for off-chain capital and off-chain investors, whether it is accredited investors or institutional investors? Why should they care? So I just want to hear from both of you guys from both of those different perspectives. So maybe Hugh, let's start with you.
Yeah, I think there's quite a few things going on. One is it's our first major stablecoin based investment. And secondly, with Nexus, we back on-chain risks. And so you don't necessarily also want to invest your float in the same on-chain risks, because if something does happen, then you're losing on both the underwriting side and the asset side. And so the fact that effectively these funds are backing off-chain risks means it's quite a good diversification play for Nexus. So there's definitely that, as well as the relatively attractive yield that the fund offers. So there's quite a few components that are perhaps specifically related to the Nexus that we had to go through to make sure it was okay. We had to make sure that our assets and liabilities are matched in the right way. We had to make sure that our members were happy giving up ETH-based upside for stable coins yield. So there's quite a few of those types of elements we had to go through. But I think one of the big benefits that this has was the diversification play.
That's a good point. Because I think a lot of DAOs, protocols, investors on chain, grapple with that or have to consider that on a daily basis in terms of diversification, liquidity, duration, all these things. So appreciate kind of the view from your perspective firsthand, and kind of all the things that you guys had to consider. Karn, talk to us about, you mentioned in conversations that we've had, that you guys will continue to do road shows with family offices and, other types of investors, high net worth, private banks, so on and so forth. What do you think why do you think this might be potentially compelling for them? And how do you feel like they should kind of consider it within your broader portfolio? Is it something that you're going to people who invest in this stuff anyway? Like, what does that look like?
Yeah. So I think one of the things that's made it a little bit easier for us is like the risk profile of the underlying is something that they're comfortable with and they understand, right? Like we back, small business insurance programs. We back agriculture programs. We back, workers' compensation, some auto insurance, home insurance. And so if you think about it from the perspective of an institutional investor, or even just like a family office, comprised or, that manages for, cash for high net worth individuals, a lot of these folks are already kind of comfortable with, one, the risk profile, two, the expected return, three, the diversification benefit. What happens with 1 million policyholders, across a diversified set of insurance lines of business can be uncorrelated with what's happening in the broader market, in the equities market, or within the crypto asset markets. So the diversification benefit is significant because these things are uncorrelated. The lens that those folks look at an opportunity like us through is, hey, this is an allocation to a relatively low volatility, high yield fixed income component of a broader investment strategy, right? For whomever that counterparty is. So it's easy to grok. It fits in neatly, so long, within like the high yield fixed income part of how they're allocating. And so it makes, pension funds, sovereigns, high net worth individuals, family offices kind of all addressable to us. And especially through the structure that we've built, the tokenized reinsurance fund, there aren't necessarily sovereigns or pension funds that can, take custody of tokens, but they certainly can take custody of, their position in an underlying fund, which has made it a little bit easier as well.
That's helpful. Thank you. Let's pivot a bit to talk about, obviously we'd be remiss not to talk about Avalanche from like an underlying tech perspective. In the architecture that you guys have outlined, Karn, there was a hybrid approach to kind of using C-chain as a public permissionless chain for the launch of the fund, as well as really like I would say, kind of almost like front end UI of the platform, and then leveraging a private permission subnet to really house more PII and other types of private information that like you need to be able to ultimately feed into and downstream into the various products and services. Can you talk a little bit more about what that architecture looks like and potentially why and how it might be fit for purpose for your guys' use case? Because I think it's a really interesting kind of configuration that you guys have built.
Yeah. So I mean, I think you've actually covered it quite well. It's a enforced premium, all of that will be managed on C chain. Subnets could offer the protocol more of this isolation in the future. So if we operate a subnet, there are privacy implications. We clearly capture PII, and we'll have more power over the types of the users that are allowed on the network. so that was attractive for us when we were, assessing partners. I think the other piece here is the Avalanche team has been great. I said this before, but the bet on RWAs, the bet on making sure that there's a bridge built, into these businesses like reinsurance, where you can essentially bring a ton of value on chain through just a generation of insurance premiums is the directionally correct bet. And so Avalanche has been, I think you guys are very well instrumented to take advantage of, not just what happens in reinsurance, but what happens where you need KYC'd individuals and you are you're re-architecting other parts of the financial, services ecosystem. So yeah, you hit it on the head with respect to how we use it. But I think more importantly, the bet that you guys have placed, on RWAs is the right one. And, we're here for that.
You're definitely playing the long game, but
yeah.
I think, I think it's funny, like a lot of the things that we're all building in this space technologically are doable now.
Mm-hmm.
But when you're talking about really upgrading legacy financial services infrastructure, like re-architecting institutional workflows, like all those things, it's going to take a while. And so like even while some more, I think the people really deep into the crypto community might think that financial services industry is like moving. I mean, they do, I guess, at a glacial pace. I think at the end of the day, you're moving such like a big, not just one industry, multiple industries. And so I think the work that you guys are doing is really instrumental in really helping to kind of move this space forward. So both you and Hugh are really kind of making a difference in the short term, and then obviously, ultimately in the long term as we bring more and more of this on chain. I can keep asking questions, but I'm sick of hearing myself talk. So Kyle, can we open it up maybe for like one or two questions, to see if we have any questions from the audience? And if not, I can maybe ask one more, but wanted to give the group a chance to ask questions if they had any for Karn and Hugh.
Yeah, absolutely. We got about 10 minutes left here, so let's see if we can take a few questions. I know, Rain, you've been requesting up to be a speaker, so if you want to drop in and ask a question. If anybody else wants to have a question for Karn or Hugh or kind of the panelists overall here, feel free to request and come on up. We definitely want to keep all the questions focused on the conversation we're having today and the re-protocol and kind of the fund that's been launched. So if you have any questions around that topic, feel free to call up and we'll invite you up. Rain here, I think, is still connecting, so that might take a sec. So we'll give it a minute for anybody to request to be up here, and if you have a question for the team here. But in the meantime, while we wait, if there's anything else you wanted to share about milestones coming up or things that folks here could look out for as the fund evolves or as kind of the protocols work together even further into the future.
Yeah, maybe Kyle, as we wait, Karn and Hugh would love to kind of hear from you guys in terms of, based on what Kyle just said, like what's next? What should we be looking out for? Frankly, both from a perspective, from a Nexus Mutual perspective, and maybe we can go from there.
Yeah, I can go. I mean, I can't talk too much about it because we still need to go get regulatory approval for some of the stuff that we're doing.
Yes, good point. Let's keep it compliant.
So there's that. But what I can talk about is like thematically what I'm excited about. When you talk to insurance folks about like, hey, crypto, a lot of these folks inevitably they think about, hey, volatility of the underlying, they think about quality of collateral. I think that there's going to be a future here where, the regulators of the insurance space, specifically in the United States, the NAIC, are going to have an increasingly tight lens around whether or not crypto assets, more native assets, can be considered admitted insurance collateral for the purposes of backing insurance companies. And I think there'll be headway made, in that regard. what I'm particularly excited about is like, BlackRock, Franklin Templeton, other providers, tokenizing, high quality collateral, or at least high quality traditionally admitted collateral like treasuries and money market funds. There is a future here where, again, we use these money Lego building blocks, and you will be able to trivially pledge things like treasuries, to a surplus capital base that backs every insurance company in the world at some point in the future. There is a home for the broader RWA ecosystem because of the pure composability of these things. Tokenization, for the sake of tokenization, in the real world asset space, doesn't generate significantly more alpha. But I think as soon as you're able to recreate, some of the TradFi flows, like being able to issue a letter of credit against a basket of treasuries or securities, being able to house things in a trust account, but analogously a smart contract, all of that stuff is going to enable not just reinsurance, but I think it's going to enable anything where a security instrument is required. So like, in trade finance, alongside a bill of lading, you typically have a letter of credit that's a security instrument that is issued to help back that particular transaction. I think all of that infrastructure is going to start to be formed around this, and I'm excited to see, the utility that comes out of the tokenization of real world assets. That's something that I think is, again, another one of these inevitable things.
Yeah, I guess on my side, the way I kind of view it similarly, from Nexus's point of view, we're looking primarily to utilize our capital base more, write more cover. I guess starting still with the crypto related or on-chain risks and stuff, like definitely focus there. But I think the way I kind of see it is a kind of this dam between the on-chain world and the off-chain world, and we're starting to see cracks in it in different places. And I think the more and more of these building blocks that Karn's talking about that get built, the more and more the opportunity is, and the quicker that dam kind of breaks down. And so we're kind of looking for growth in the on-chain world to start with, but once the opportunities actually pop up and we then have the opportunity to then use our capital more freely to back stuff in the kind of real world, and tokenize things, etc. Where I think we're very well placed to be able to support that journey, and that market that I think will come on chain eventually. I think it's definitely slow and steady. It takes regulators a while, takes the insurance industry a while to adapt to change, that's for sure. But it's definitely coming, and I think we're well placed to capitalize on it when it shifts.
You guys are both definitely preaching to the choir as it relates to what we're all excited about. So definitely looking forward to continuing to work with you guys. You guys have been awesome kind of in this journey and within this broader Avalanche ecosystem. So thank you to both of you, and thank you guys for joining us. Maybe any final thoughts from either of you guys? Otherwise, we'll wrap it up. But thank you again, Karn and Hugh, for joining us. Obviously, thank you to our audience and our community for joining as well. But Karn and Hugh, any parting thoughts?
Yeah. I mean, look, there's so much to be excited about in this space. It is kind of, Hugh alluded to, we're placing the first bricks of a foundation, that brings $1 trillion market on chain. There are individual reinsurers and insurance companies that have more surplus capital locked up than there are, for example, USDC in circulation. And so the uptick from here, it's really an order of magnitude. It's massive. It's coming, and I think folks should keep an eye on it and be excited about it.
Yeah, I mean, I'd echo that, but like the insurance industry doesn't get a lot of, I guess, exposure generally. Yeah. Especially compared to banking, but the fact is it's absolutely massive. And the numbers there, like you just have to get a small part of it and that can make a big difference. So I think, fully agree with all that. But yeah, I think we're all kind of in the right spot, pushing forward and all the rest of it. And it's hard going sometimes, but it is changing and it's moving in the right direction. So I'm looking forward to seeing where it goes.
Awesome. Thank you both. Kyle, let me hand it over to you to wrap it up.
Yeah, definitely appreciate you both coming on here. I'm sure we're going to have future conversations where we bring you on as well, because like you said, this is just the initial foundation that's being built, and we're going to see a lot of growth coming here in the future. And so thanks for joining us. Thanks for breaking it down. Thanks for kind of giving an overview of what you're being built and kind of a vision for the future. So we're excited to keep building alongside both of you. And thanks, Morgan, for leading the Money Moves conversations as always. We'll have this recording up on YouTube in the next couple days. And then, we'll be sure to share more as things develop, both from the Re side and from Nexus Mutual. So appreciate everybody for joining us. We'll see you all next time. And thanks again, Karn and Hugh. We will see you all soon.
Thanks, y'all.
Thanks, guys.
Thanks, everybody.